What's going on? We're back. It's another YouTube video. This one is about mania. It's about psychology. It's about the community. It's about the things that you see around you every single day. I'm going to break it down, relate it to the economy. You might think I'm right. You might think I'm crazy, but I don't really care. So let's go. Okay, so one of the constant themes you'll see in an economy that's really frothy is this undeniable fear of missing out that people have. It's like this confidence that it's always gonna go up, and you got Bitcoin, you got cryptocurrency, you have real estate, you have all these things that are booming, and you wanna get in, you wanna get involved. Wait a second, before you do that, I wanna break down the psychology of frothy economies to you, but I'm not going to tell you from my words. I'm going to tell you from a man much smarter than me's words. And I'm going to give you the play-by-play on what that actually means. So because this is actually quoting somebody, a very intelligent economist or macroeconomist, if you will, I'm going to read from the article and then I'm going to comment on how that actually relates. But one of the things I want you to keep in mind, this article is actually from April of 2009. And why that's relevant is it's just after the beginning of the Great Recession, and it was before the current very prosperous economy. So I want you to see how there are trends that are reoccurring in today's economy 12 years later. So the article titled Hope, Greed, and Fear, The Psychology Behind the Financial Crisis, originally written by Richard Herring, from the Wharton School of Business. And Wharton, for those of you out there who don't know, is one of, if not the best business schools in the country. So the man obviously knows what he's talking about from a pedigree standpoint, if you value that kind of thing. Like so many others in history, the last economic crisis began with the bubble, according to Wharton finance professor Richard Herring. Specifically, he said that bubbles occur when people are willing to buy something simply because they believe they can sell it for a higher price. Bubbles often have an aspect of mania. Does this sound familiar to you? People are buying cryptocurrency because they believe they can ultimately sell it for a higher price. People are buying real estate today because they ultimately believe they can sell it for a higher price. And stocks are no different. It almost seems like no matter what you do in today's economy, you can't lose because you're going to win on appreciation alone. And people were shocked to see the tumble in cryptocurrencies shortly after, Bitcoin went down and Dogecoin went down. And people were shocked to see so many of these things happening, but they continue to point to the economy in aggregate and saying, you know what, we're not in a recession. We're not in a recession. And at some point, you have to take a 30,000-foot elevation look at how people are responding and ask yourself the question, is this now a psychosis? Are we believing things because we want to believe in them, or are we looking at the actual evidence, the physical evidence that's out there? Some of the things that have changed as of late is the real estate market, which was white hot on fire and is still hot, now has supply coming back in the market. There was a shortage of supply, so home values were skyrocketing because between that and the low rates, it was nuts. There's a lot of things that are happening. You've got inflation that's starting to kick in. You have the Fed saying something to the effect of, inflation is higher than we expected, but it's still in line with what we expected. If that doesn't scratch your head and go, that seems weird, I don't know what else to tell you. That's a weird thing for the Fed to say. But let's continue on in the article. You're going to see parallels and things for you to consider and think about in aggregate. Property bubbles are nothing new, said Herring, who presented a chart of home prices during a 400-year period in Herrengracht. I'm not from Amsterdam. I have no idea that's how you say it, so take my word for it. It's spelled like that. Essentially, it's a canal area in central Amsterdam. Over those centuries, 400 years, mind you, real home prices increased annually by only 0.2% on average. But in between, they were up at periods 100% or down 50%. There was huge volatility over the period of 100 years and definitely over 400 years. But when you look at it in the totality of the circumstances after a 400-year period, only a 0.2% increase. And that goes to show you how we as humans tend to think about things like our lives. Most humans don't live to 100 years and beyond, so you tend to think about life in the perspective of 10 years or 20 years. In this last economic cycle, which was very prosperous for a lot of people, it's been literally 13, almost 14 years of economic prosperity. So of course you're predispositioned, now conditioned to believe that good times are here to stay. As a matter of fact, if you talk about people If you talk to other people about where the economy is going, they're going to point to real estate. Oh, you know what? You've got CoreLogic, you've got Moody's, you've got Redfin, you've got Zillow. They're all predicting real estate values to increase next year. And you know what? Predictions are all well and good, and I can make speculations based on fact for the future as well. But here's something you need to get your arms around as an individual consumer. We have been through an unprecedented pandemic, an unprecedented period of economic interest rate deflation. No one knows what happens next. It's all speculation. Recessions tend to last 7 to 10 years on average. And if you go to the Federal Reserve Bank of New York, they have a wonderful chart on this. We are now in something that's almost double that. So we are in a weird position we've never been in before. And for anybody to tell you with certainty that they know what's going to happen next year, I can tell you right now, there is no certainty. Let's continue because it gets even more fun. Real estate booms and busts happen in very long cycles, on average about 20 years. And yes, 20 years on average. That means a real estate cycle is up and down. So what does that mean? 7 to 10 years on average for one cycle, 7 to 10 years for another cycle. That winds up being 14 to 20 years. That's what they're talking about here. Consequently, when housing prices are going up, few remember that they went down. If you're in your early 30s and you've been working for the last 13 years, since you were 20 years old, you might not actually remember what it was like to live through a recessionary economy if your parents were fortunate not to have been hit hard enough for you to feel the impacts at a young age and remember them. So think about that as you look at the economy from a larger, longer, broader perspective. This was certainly the case in the recent crisis, since housing prices only went up between 1975 and 2006. Between 1975 and 2006, home prices on average went up. And I'm sure there were periods of blipping up and down, but if you took a 30,000 foot elevation once again and you look at it from a big macro perspective, they essentially went almost straight up over time. There was huge increases in real estate. And yes, there were some recessions built in between 1975 and 2006, certainly the 80s, certainly the 1991, but most of them didn't impact real estate values the way the Great Recession did. Continuing on, according to Herring, property markets are especially prone to booms and busts because of their nature. They have no central clearinghouse of information about prices, transaction costs are high, and trading is infrequent. And the supply of property is relatively fixed in the short term. And we're experiencing that more now than ever. Keep in mind, Herring wrote this in 2009, where he's talking about how the supply of inventory is relatively fixed. And what are we facing right now? A supply shortage, which is helping to drive the cost of these properties up. It's the inflation that we're starting to see in the economy. So are we in an inflationary period? I think absolutely at this point. There will be those who argue. I can appreciate that, and I respect a very educated debate if someone wants to have it with me. Are we going to look back in 10 years and say we entered a recessionary economy now? I think the answer is yes, but it's going to be a different type of recession than we've ever experienced before. You've removed all this elasticity from the economy by doing these things to really slow the economy down to a crawl. It's going to be a slow move over time into a recessionary economy. It's not going to be overnight. And I think we're starting to see some of those warning signs. But let's continue to read about what Herring has to say. Because the cycles are decades long, it is difficult to tell what a piece of property should be worth in the long run. And long run here means more than your life or my life. We tend to think about real estate in 40 or 50 years. But as we know from what Herring has already told us, that in 40 or 50 years, real estate values can go up dramatically or go down dramatically, 100% or 50%, as in it happened in Amsterdam. But over the periods of hundreds of years, centuries, values tend to stay about the same. And I know statistically people are going to challenge that. I encourage you to do that. Think about that with the inflation, the actual value of a dollar. And I think you'll find that Herring is right. And frankly, Herring's a lot smarter than me, so I'm going to take his word versus anybody on the internet if you're a troll. No offense to trolls. Go ahead and hit me with facts. We'll talk about them later. But let's continue on. We really don't know what a price should be, so it's always difficult to tell whether you are looking at a bubble or simply improving fundamentals of the economy. I think that statement, that quote from Herring here, is even more powerful than people realize. We tend to look at property values based on the desirability for us at the time, but there are so many other factors that go into desirability as it relates to real estate, as it relates to stock, as it relates to the economy. It tends to be that these things increase over time, but the value of a dollar has changed dramatically in the last several centuries. So you have to understand that there could be a little bit of inflation and a little bit of the economy changing dramatically in the way we look at things that is causing the values to change. It could not necessarily be just the real estate inherent value on its own. When it comes to buying your own personal property, I always tell people you really shouldn't think about it in the form of investments. You should think about it in the form of utility, what buying that property for you does at that point in time in your life and your family. But buying an investment piece of real estate, this is also why I caution people to always buy stuff that's cash flow positive on day one. If you're an equity player where you're buying something and you're going to try to find more equity over time, or you're an appreciation investor, which is more of a technical term, those are very scary positions to be in a market like this. If you're buying a property that's at full top of market rents, there's really only downside potential when we're looking at where the economy could go from here. I'm not saying that rental rates will go down. I'm just saying they're not going to go up much higher at this point. So you have to be cautious of downside risk as an investor. I'm going to finish up with this last paragraph, and I think this one's probably the most powerful paragraph that I've read so far. Housing booms and busts are almost always linked to the banking system. Me as a banker, my ears perk up and I go, oh my God, we did it. Bankers are evil. Well, in this case, I'm not saying that bankers are evil, and I don't think Herring is either, but bankers are certainly part of the problem. And when you understand the macro and microeconomic reasons as to why, you can see how this has a very big compounding effect. Herring added, when something good happens in an economy, it tends to drive up real estate prices. And banks tend to lend to support that because people have collateral now with higher values. So if real estate values are going up and banks continue to lend at, let's say, 75% LTV or 80% LTV or 90% LTV, that's more and more money in an increasing environment. Some areas this year alone increased in value 24 or 25% in value. And if you went out and got another loan because interest rates are super low because you were being, smart and forward thinking, and you happen to pull some cash out, that bank is levered at a very high number that they wouldn't have been able to get at just a few short years ago. So think about where all this money is in the economy. Some people that are naysayers will say that there is a huge benefit in that GDP, gross domestic product, which is made 75% up of consumer spending, should continue to drive the economy higher. But you have to understand that you can only drive the economy so much higher with consumer spending while there's a shortage of supply chain items coming in. They're talking about Nike having shortages of supply. Wood costs are going up. The real estate values had shortages of supply. You're starting to see microchips have these impacts. There is a lot going on, and it's all over the news, but it's not as significant and it's not as media worthy. It's not as sensational for the most consumers to really take in and metabolize. But you're starting to see those things in the news. And you should look at those things and ask yourself, is this going to impact the broader economy? And in most cases, the answer is frankly, yes. So let's wrap this up here. I think this is impactful. Optimism about rising prices feeds the frenzy. And as an increasing number of novice investors enter the market, prices and enthusiasm also increase. You get into this upward spiral that can take you a very, very long way for a very, very long time. So really, you see that this system feeds itself. The economy is doing well, banks lend higher, values go up, banks lend more, and banks, me as a banker, we're somewhat responsible for feeding into this frenzy. But at the same time, the consumer is also responsible for not being cognizant of the risk. You can blame the regulators for allowing, certain increases in value. You could blame a lot of people, but the fact of the matter is, this is just the psychology of humanity. I will say that this also parlays into the mania, the psychology, the craziness of the masses of society. People see this. They start to believe this feeding frenzy of this economic increase, and they don't want to hear that it could go the other way, that it will go the other way. They don't want to point to facts that are right in front of them, things in the media that we just talked about. What I'm really trying to say to everybody, what I'm trying to say to you, what I'm trying to say to anyone who watches this, is you have to keep a neutral perspective on the economy and be savvy. Because the one thing I can tell you unequivocally I've seen, as a guy who was a former underwriter who looked at very wealthy people's financials, very, very wealthy people got wealthier in times when the economy changed to bad. And if you can be cognizant, have liquidity, be positioned to buy when values go the other way, you will be a millionaire. Recessions make the next generations of millionaires. Believe it, take it in. I don't care. Those are my thoughts. I hope it was educational. I hope it gave you something to think about. Take a look at the article. I only gave you a little bit of it. The Wharton School has got some wonderful free public information to look at. The Economist data is spectacular. That's from April 2019, and I think it's worthy of a read. It's very, very, very much applicable to a lot of what we're seeing today, but yet it was written about the Great Recession so long ago. Remember to tune in, like, follow. Your likes mean a lot to me. You following me means a tremendous amount. We've grown this channel from 0 to 145 subscribers. I love all 145 of you. TikTok, Instagram is growing. Hit the like button, follow, subscribe. We appreciate you. We'll see you next time.